This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 24 of Value Investing. In the last episode, I discussed why you can find a lot of undervalued opportunities in the space of spin-offs. In this episode, I'm going to go over one example of such spin-offs and discuss what are the things you can do as a value investor to identify great investment opportunities in this space. I'm so excited to go into the details. And before I do, let me just give you a quick disclaimer that this podcast is for entertainment purpose only, and it is your responsibility to consult with your investment professional for any investment decisions. Without further ado, why don't we get started? Joel Greenblatt is the guy that I'm interested in talking about, and as I mentioned in the last episode, he's the founder of New York-based Gotham Capital Private Investment Partnership, and his stock portfolio has achieved returns of 40% over 20-year time period. So I wanted to know everything about Joel Greenblatt, so I purchased all the books that are written by him. One of the books that I'm discussing here in this episode is called You Can Be a Stock Market Genius, and I'm going to put a link in the show note so that if you are interested in buying, you can just go there and buy from Amazon. In the last episode, we discussed 4 points why spin-offs provides a lot of undervalued opportunities. Let me just quickly recap. When spin-offs happen, the shares of the new spin-off stock are distributed to the existing shareholders of parent company, and they may not want these shares because they got into the stock because of the parent company's business model. And when the parent company spins off a small section or a small portion of its business, they may not be interested in holding these shares. Second, the spin-off companies are usually small in size and may not be worth for institutional investors to hold these shares in their portfolio. Third, spin-off provides a lot of opportunities for management to unleash their entrepreneurial forces. More accountability and more direct incentives will be given to executive team, and it's going to better incentivize them to do the operation more efficiently. And lastly, there's motivation behind the spin-offs and mostly shareholder friendly. Most business executives seek to expand their empire, domain, and influence by acquiring more companies when the acquisitions come at the expense of shareholders. But spin-off is the opposite case where the management team values shareholders and they reduce their domain of operation. So it's likely that it's going to be an indication that executive team is shareholder friendly. So those are the 4 points that we discussed last time. I highly recommend to you, if you haven't listened to the last podcast, you can do so. And I discussed all the details about these 4 points in the last episode. In this episode, as I mentioned in the introduction, what I'm going to do is I'm going to go over one case study on a spin-off case and try to discuss what are the points you may need to look for in order to find great spin-off opportunities. On today's show, I'm going to talk about Marriott Cooperation. So let me just give you a brief background. During 1980s, Marriott Cooperation expanded its business aggressively by building a large number of hotels. However, the cream of their business was not owning hotels, but charging management fees for managing hotels owned by others. So here's their strategy. So their strategy was to build hotels, sell them to others, and keep the lucrative management contracts for those same hotels. It worked out really well during 1980s. However, things got really bad in the early 1990s when the real estate market plummeted. Marriott had taken on the billions in debt to build hotels, but Marriott couldn't sell the hotels in an overbuilt market. So Marriott was in a big trouble with a lot of debt. Stephen Bollenbach, then CFO at Marriott, figured out a way to resolve the issue for Marriott Cooperation. By the way, this is the guy who helped Donald Trump turn around his gambling empire from bankruptcy. Bollenbach's solution was to spin off Marriott's lucrative management contracts business called Marriott International and leave all the debt in another company called Host Marriott. So the bottom line is that the spin-off company, Marriott International, would have all the good things: debt-free, lucrative business with tons of cash flows, and the parent company, Host Marriott, would have all the bad things: a load of debt, low growth business, and so on and so forth. So what I'm going to do is, from now on, I'm going to call them Good Marriott and Bad Marriott to facilitate your understanding better. Now, the big question is, which entity was Joel Greenblatt excited about when these things happened? Joel Greenblatt was excited about the Bad Marriott. Because who the hell is going to own this thing? The Bad Marriott will have unwanted real estate and billions in debt without having lucrative management business. The selling pressure would be tremendous and provides a good opportunity for value investors. However, value investors just don't buy toxic assets at a bargain price. Not all contrarian buys are correct. After all, the market could be right. So we should do our research to see if the asset is mispriced in the market. So let's see what excited Joel Greenblatt beyond its obvious contrarian appeal. So there were 3 points that made the Bad Marriott so attractive investment for Joel Greenblatt. So he laid out 3 points in his book why he thought that the Bad Marriott probably got a bad rap. It doesn't deserve those bad rap when spin-off happened. On top of that, you can apply these 3 points not just to this specific case, but you can apply this one generally to other spin-off cases. So that's why it is important for me to discuss these points so that you can apply that for your future investment cases. So what I'm going to do is I'm going to go through each of these cases and see where Joel Greenblatt saw the value in this investment in the Bad Marriott. First, Joel Greenblatt realized that institutional investors wouldn't want this investment, and their reasons don't involve the investment merits. And this is one of the points that I discussed in the last episode. And the question now is, why do we have to care? We need to care because the institutional investors are the ones with tons of money and could make the price go up and down significantly in a short period of time. And that's what matters, because it's going to provide you an opportunity to buy the stocks at a very cheap price whenever you see huge selling pressure in the market. According to analysts quoted in the initial newspaper reports, the Bad Marriott would account for only 10 or 15% of total value, which was $2 billion of entire Marriott Cooperation, with the rest of the value attributed to the Good Marriott. So when this spin-off happens, the Bad Marriott is going to be only 10% or 15% of previous enterprise. So it's going to be a small portion, and most institutional investors would not see the size of this new entity appropriate for their portfolio. So the bottom line is too small to be included in their portfolio, and for additional analysis. So clearly you can see here that sales from these institutional investors are not based on any specific investment merits, but simply based on the size of new spin-off companies. So that is number one reason why Joel Greenblatt thought that this is a great opportunity for him. The second point that he mentioned is that insiders wanted these new entities. So now the question again is, why do we have to care? We need to care because insiders know way more than outsider investors regarding the business. And this is not just specific to spin-off cases, but everything in general. So whenever you're trying to make good investment decisions and whenever you're trying to find out good hints from different investment opportunities, one of the key areas that you need to look for is to see whether insiders are buying shares of that company. Think about this one a little bit carefully, because if you are insiders and if you know more information and you know that the share price is selling at steep discount compared to intrinsic value, your inclination is going to be to buy shares while the shares are selling at a bargain price. As I mentioned, this is not specific to just spin-off situations, but can be applicable to any investments in general. So in many cases, what I do when I try to find out on the value investment opportunities is go to different websites that show insider information. I can find out how many insiders purchase how many shares at what price, and all of this information should be publicly available, and some websites summarize this type of information very well, so I go to such websites. So one of the websites that I go to is growfocus.com, and I can find out how much insiders have purchased their shares. And you need to know how people define insiders, usually executive teams and also directors in the board. And that's a really good hint, because if insiders purchase shares with their own money and they purchase shares out of their own pocket, then that means that they really believe that this company's future is rosier than the market perceived at that point in time. And they believe that market is not valuing the company correctly and intrinsic value is a lot higher than the current market price. So it's a really good hint that I think everyone should focus on. And this information is readily available for free. So why don't you take advantage of that? In the case of the Marriott spinoff, Stephen Balloon-Betch, the architect of the plan, was to become the CEO of the bad Marriott. And now that you have to ask the question, why would he voluntarily throw himself into the sinking ship? If he truly believed that this bad Marriott is not going to be able to survive and it's going to go bankrupt anytime soon, he's not going to voluntarily throw himself into this CEO's seat. But he probably thought that he could turn around the ship and turn around the company in sometime soon, and he probably thought that there's a good chance that the company is going to survive. And that was number one cue that Joel Greenblatt got from this spin-off documentation. Additionally, the Marriott family was still going to own 25% of the bad Marriott after the spin-off, which means it would be still to the family's benefit to have the stock of the bad Marriott thrive in the future. So insiders definitely had huge stake in this bad Marriott, and they had huge interest in bad Marriott surviving in the future. So those are the two key aspects that were important for Joel Greenblatt to consider. The last point that he mentioned why he thought that this is a great opportunity for his investment was a previously hidden investment opportunity was created or revealed. So what does that mean? So this could mean that a great business or statistically cheap stock is uncovered as a result of the spinoff. In the case of Marriott, Joel Greenblatt noticed a different kind of opportunity, which was tremendous leverage. So let's just go back in time and see what happened during this spin-off situation. Based on the initial newspaper report, Joel Greenblatt realized that the new spin-off company is going to be approximately $5 per share with $25 debt. So in total, the enterprise value of the new spin-off company is going to be $30 per share. And as I mentioned, $5 for equity investors and $25 for debt investors. This means that if the total asset goes up in value by 15%, the stock would double in value. So that's a huge opportunity. But you might ask, what if the total asset goes down in value by 15%? Then it's going to wipe out the equity portion. So it is very risky if you don't know what you're doing. But Joel Greenblatt asked, what are the probability of the asset going down by 15%? Joel Greenblatt thought that it was very unlikely because of following reasons. Number one, with prospect of liability and lawsuits from creditors, employees, and shareholders, a quick demise of bad Marriott was not part of the plan. Think about it. You put all the bad things into bad Marriott and you spin off this bad Marriott from this good Marriott. And if this bad Marriott goes bankrupt right after the spin-off, there's going to be a lot of lawsuits and it's going to be a huge headache for even good Marriott management and owners. So it's not in the best interest for good Marriott to let this bad Marriott go bankrupt in any time soon. So that was one reason why Joel Greenblatt thought that it's not likely that the asset is going to go down in value sometime soon. The second reason is that the good Marriott agreed contractually to lend the bad Marriott up to $600 million. This is a huge amount of money back then for the bad Marriott. And remember, I said that the bad Marriott is going to be account for only 10% to 15% of $2 billion of total Marriott Cooperation, so which was around $200 million to $300 million. So that was the second reason why Joel Greenblatt thought that the bad Marriott is going to survive in the near future. And third, as I mentioned before, Marriott family still owns 25% of the company. And Bullen Batch, the CEO of the bad Marriott, would be heading up the company. So that's a huge sign that actually led Joel Greenblatt to conclude that this bad Marriott is going to still survive in the future. All in all, it seemed in everyone's best interest for the bad Marriott to survive and hopefully thrive in the future. And when you combine all these reasons with tremendous leverage, Joel Greenblatt thought that there is a good chance that equity investors can double or even triple their equity investments. So now the big question is, how did things work out? It worked out beautifully. Many institutions managed to sell their stocks at a very low price. Insiders, according to the SEC filings, ended up with a big vested interest. As nearly as 20% of the new spin-off company's stock was made available for management and employee incentives. Finally, the debt situation, a big turnoff for many investors, turned out to be structured much more favorably and attractively than it appeared from just reading the initial newspaper accounts. The stock of the bad Marriott nearly tripled within 4 months of the spin-off. So as you can see, Joel Greenblatt reviewed initial document of the spin-off and was able to identify great opportunity for his investment. Let's quickly recap what we have discussed. There were 3 points that made the Bad Marriott an attractive investment for Joel Greenblatt. First, institutions didn't want the shares, and their reasons didn't involve any investment merits. Second, insiders had vested interest for this Bad Marriott to succeed, and they had huge stakes in the company. Third, previously hidden investment opportunity was created from the spin-off, and in this case, it was tremendous leverage. And I discussed a couple of points why Joel Greenblatt thought that this leverage is not as risky as it appeared in the first newspaper accounts. So one thing that I want to point out here is the fact that Joel Greenblatt used his common sense in order to find out undervalued investment opportunities. If you had used quantitative algorithm, then you wouldn't be able to capture this common sense. Think about it. This is why I think we value investors have huge advantage over quantitative investors who now dominate huge portion of the market. And also we have competitive advantage over ETF investors because they do not really read any of this information. Okay, that's it for today's episode. I hope you enjoyed this episode. If you want to leave any comments or feedback, please do so at valueinvesting.blueberry.net. And 5-star review always goes a long way wherever you listen to your podcast. I really appreciate you listening to my podcast, and see you next time.